Return and safety at the same time? What kind of sorcery is this? It's possible. And you can do it too. I'll show you how in this week's lesson. What's up everyone? Welcome to a new video from PerFinEx, the #1 financial planner for expats living in Germany. After this lesson, we will have completed the Magic Triangle of investing with all its side and all asset classes that you can potentially invest in. So you will have the complete picture of the investing landscape in Germany and you're almost ready to start investing. So congrats to everyone who stuck with me through the weeks. But wait, there's more. Maybe, just maybe, our Magic Triangle is actually a Magic Fiveangle. Because there are two more very important factors that influence our investment decisions. But more about that next week. Before we start today's lesson, let's take a look at last week's quiz. What do you think is better? Because, well, my opinion will probably piss off a lot of disciples from the holy ETF religion. Because the right answer is C, it depends. By the way, if you do not know what the difference between an ETF and a mutual fund is, you can watch the last lesson right here. If we look at where money from investors went, we see clearly that ETFs have become increasingly popular over the last years. Which is no wonder. The global stock market went basically only one way since 2009. Up. And since ETFs just replicate an index, they have done very well. Better than most mutual funds in fact. One of the reasons being that the market only went up. Second reason being that ETFs have a clear cost advantage. Every fund has a management fee for putting the basket of individual investments together. An ETF is pretty cheap with about 0.5% per year. A mutual fund can cost anything between 1 to 2% per year, so up to 4 times as much. If you calculate this over the years and the decades, you will pay quite some fees to the professional fund manager and his team. So any fund manager has to be like 1% better than a comparable ETF just to recover his fees, which is pretty difficult as the market turns out to be very efficient over a long period of time. Not impossible, but difficult. By the way, if you're at an old school bank, they might even charge you some additional sales charges for buying and selling mutual funds. Our clients don't, so it might be a good idea for you to change banks if you want to save some money while investing into mutual funds. As I'm here educating you and not pitching any products, let's look also at the upside of mutual funds. Because I don't believe that ETFs are the universal solution for everyone like many people think they are. As I mentioned in last week's lesson, if you need your money within the next 15 years, you would take an incredible amount of risk by investing in ETFs. Because don't fool yourself and think just because stocks go up in the long term, they also go up in the short term. Because they're not. In the last 20 years, we have seen 50% drops like 3 different times. So every fund has costs. ETFs less than mutual funds, but they still cost. Consequently, if an ETF simply replicates an index, it will always have a lower return than the index itself, because you have this 0.5% management fee. So an ETF can never ever be better than the index it's replicating. A mutual fund can be better. Here's why. If the market goes down, the ETF goes down as well. A professional fund manager can react, an ETF can't. In a falling market, the mutual fund manager can protect his portfolio by building up some cash. If a fund manager holds 10% cash and is only 90% invested, he will only lose 9% instead of 10% if the market falls. Secondly, let's take the S&P 500 as an example again. It's an index of the 500 largest companies in the US, and an ETF just buys shares in exactly the same distribution as the index is. Now, some of these 500 companies will do better over time, and some will do worse. That's just how it is. In some cases, it might even be possible to predict some companies will do worse because they're already in a bad situation. While the S&P 500 ETF simply buys the average, a professional fund manager can decide to not buy the bad companies and buy more of the good companies. In other words, you will feel more benefit from the profits of the good companies and feel very little of the bad companies. To sum up the quiz question, because it has been quite a long answer today, I'm not a big fan of the either-or view in many things in life. But if you want to look at it that way, fine. You can either buy a cheap copy of an index or a more expensive version that cushions the fall downwards, but has a difficult task to beat the index on the upside. And if you don't like these 50% drops that we had in 2001, 2008, and earlier this year, nothing wrong with that. At the end of the day, no product ever should take the most fundamental question away from you, how you want to structure your assets. You should use your freedom to choose your individual investment strategy yourself, free of any limitations. That's why right now, we're talking about the third side of the Magic Triangle to complete the picture and make you a true investing expert. And for any of you out there who still believe product beats strategy, let me tell you one last thing. The fact that this product has performed better than that product in the last whatever years doesn't mean anything, because past performance is no guarantee for future results. Alright, coming from the strategic level down to product level, can you think of some asset classes that are safe and generate a return, but maybe they're not that available? I think the most obvious asset class is real estate. Now, every once in a while some smartass says, a house can burn down, it's not that safe. True, a house can burn down, but you can make an insurance against it. And of course, an investment property offers a certain return in the form of rental income, or if the value of the property itself increases over time, which it did a lot in German cities over the last years. I said very deliberately investment property because from a financial planning point of view, an investment property that you rent out is completely different from a home you buy for yourself and your family to live in. If you are interested in a comparison, real estate, home versus investment, or if you want to know more about real estate in Germany, let me know, drop a comment below, and I'll make a separate video about it. Now, availability is an interesting point when talking about real estate, because a real physical property has indeed a very low availability. You cannot buy or sell it overnight, simply because of our super necessary German bureaucracy, of course. What many people don't realize is that it doesn't always have to be a physical property. There's many different ways to invest in the asset class real estate. There are open real estate funds, closed real estate funds, real estate investment trust, which is a very interesting concept, by the way, with certain tax benefits. All of these products, even though they invest in real estate, can be quite available. Similar to pensions. There are available pensions and there are not so available pensions. So it's not all just black and white. Speaking of pensions, A large majority of private pensions allows you to invest in mutual funds and ETFs. Remember from last lesson? So think of pensions like an umbrella that you can put over your funds that take away a certain availability, but give you in return a lot of other benefits. A level of security if you want, state benefits that would increase your return even more. You can also save a shitload of taxes with pensions too. Yay! Free money! If you want to know how our pension system is built, let me know. Drop a comment below, then I'll make another video explaining everything in detail. Now that you know the complete triangle, you can see that all sides offer conceptually and strategically useful and very interesting products. So again, don't be a Steve and think, do I take this or do I take that? Rather, be an Amanda and make sure that you and all your assets are positioned in all three corners of the triangle, according to your personal investment mentality. Now that you know all three sides of the triangle, it is a very good opportunity to talk about the relationship between risk, the possibility of losing your hard-earned money, and return, what profits you can make from investing. Because what I see with many new clients who have already invested before meeting with us is that most of them take far too much risk for the performance they generate for themselves. Generally speaking, the greater the risk you're willing to take, the greater your possible return. What we do see though is a graph of diminishing return the more risky we invest, basically a saturation curve. Think of your bank account that offers the so-called risk-free interest rate. For zero risk, you get zero return. Seems fair, right? Remember the Nobel Prize winning economist Milton Friedman. There's no such thing as a free lunch. In the beginning, you can generate a decent amount of return relatively quickly for a relatively low risk. And in the end, you could get greedy and say, I want more and more and even more, but at what cost? Not in terms of monetary cost, but cost in terms of risk. Because at the back, where the curve is almost flat, you're basically playing the lottery. I know you can win a lot, but even a lottery win is limited. The risk is virtually unlimited. So the relationship between X and Y is the investment efficiency. How much return are you getting for how much risk you're willing to take? And what I see from many Steves out there when they seek our help is that their investment efficiency can be increased greatly if you know how to use synergies or simply understand the interactions between certain investment products. Like Amanda, as our smart investor, she is investing far more efficient on this line instead of Steve's line. So she has two options. First, if she's willing to take X risk, then she can get some extra return that Steve is missing out on. Or she can decide that the return she's getting is enough for her and achieve the same result by taking far less risk. And to be successful in investing, you need to figure out your personal risk tolerance. We determined that most investments fluctuate. So you have the freedom to choose the range that you allow your investments to go down, because that's the real problem. Nobody ever called me complaining that his investments rise too much in value. Imagine investing like a roller coaster ride. Values go up, values go down. If you choose a ride that is too wild for you to handle, you will get scared when it dives and you will panic. And when that happens in investing, you will sell all your assets at the worst possible time right at the bottom, like many Steves do. Amanda knows that the key to successful investing is to stay invested over a long period of time. And some people like steep roller coasters, and some people like smooth roller coasters. There's no right or wrong. To help you finding your personal risk tolerance, try to imagine you invest 10,000 euros. The next day you log in to check the value and see there's only 9.8k left. 9,000 at the end of the week, 8,000 the week after that. At what point do you say, "Stop! I lost enough of my hard-earned money"? And there's your risk tolerance. That's why random people throwing out random investment advice is so mind-boggling to me if they don't know the risk tolerance of the people they're talking to. Because the appropriate safety of your assets has always the highest priority. Last but not least, today's quiz question. What is more important? A, the investment product, B, the investment strategy, or C, it depends. Let me know what you think in the comments and I'll give you my opinion next week. By the way, next week we'll talk about the super interesting topic of taxes. If you got any questions, write them with the hashtag #AskPerFinEx in the comments. If you want help figuring out your individual investment strategy, scan the QR code and book your free meeting with us. Stay safe everyone, and see you in the next video.